Well, let's get started. We are the second to last panel of the day, I believe, so we only have a little bit of time between you and your drinks, so we will give you some great content, I promise. And to introduce myself, my name is Eleanor Terrett. I am the host of the Crypto in America podcast and newsletter, formerly of Fox Business, where I covered crypto policy. And I have some amazing guests with me here today. I'll let them introduce themselves. So we'll go down the line. We'll start with you, Ubair, but also introduce yourself, tell me where you're from, and tell me one thing that you're excited about in the institutional crypto space right now.
Thanks, Eleanor. My name is Ubair Javaid. I'm the CEO and co-founder of Nomyx. We provide technology infrastructure for asset managers to transition on-chain in a seamless manner, with removing all the friction points typically associated with tokenization. What I'm excited about most in the crypto space or tokenization space today is that we're finally moving from POCs to actual scalability, where asset managers and financial institutions alike are actually going out and they're shifting their mentality from can we to, okay, we can, but how do we actually make it scale now? So it's an exciting time to be in this space.
Hi, everyone. It's Rick Golubov from Franklin Templeton Digital Assets. Great to be up here. And I focus on partnerships for our group, but that's very vague. We're almost like a small startup within Franklin Templeton. We're focused on 4 chunky initiatives ranging from tokenization, building out model portfolios, ETFs for clients and advisors. We have a node operations group, and we also have a blockchain VC team that rolls into our kind of 50-person team. We're super excited about the opportunity set that's before us, and all our peers here today. So it's great to be sharing, this amazing time where we're starting to see things really take off over the next, it's 2025, maybe the next 5 years or so. I think things will be a lot different from where we were just a couple years ago. So if there's one particular thing, I think it's all about providing choice to clients. Being at a large asset manager, we have the ability to reach a lot of different clients across the globe, and offering them choice, I think, is a huge opportunity set for everyone in this room to be able to deliver on a lot of different things within the industry. So,
you stole my answer. My name is.
What happens when you go last?
I'll come up with something by the end of this spiel. My name is Andy Czupek. I am the America's head of digital asset innovation and advocacy at Northern Trust. Northern Trust, for those that don't know, is a large institutional bank, actually a medium-sized institutional bank. We provide asset servicing, custody, asset management, and wealth management for institutional clients, family offices, et cetera. We currently custody assets for about $17 trillion, global bank in about 104 different countries. And I think that when you look at somebody like us being involved in this, we've been involved in this space for about 10 years now, 12 years, I think, really. And we absolutely see how we have to provide that entry point for our clients into these kind of assets. And I would say the one thing that I look forward to, right, is really similar to what everybody said here, is just the capability to build new ways for clients to get new products, new assets, and really find a way to make it as easy for them as possible to transact in a new world of marketplace and assets that can make their lives easier, quite honestly.
Awesome. Thank you for all your introductions. So I want to start. You guys are all coming at digital assets and blockchain from different angles, different kinds of companies, but you're all working towards the same goal, which is trying to make digital asset investing, tokenization easier for investors and for clients. I'm curious how the clientele is responding to tokenization. I think everybody here is pretty familiar with tokenized assets and how the blockchain works, but some of your clients might not be. So how are they responding now in this current environment?
So at Nomyx, our vantage point on tokenization, while some of the larger players like Securitize are focused on treasury bills and highly liquid assets, our primary target market is in the alternate asset space. So we're looking at tokenization of private equity, carbon credits, at trade finance, accounts receivable invoices. So asset classes that have some level of inherent liquidity, but they're not in the public markets, they're in the private market domain. So what our primary objective at Nomyx was to allow these alternate asset managers to reduce their middle office and back office administrative burdens through tokenization. Most of these clients, when they come to us, they're not actually asking us well, some of them ask us that they're interested in tokenization, but most of the time they're like, okay, how do I reduce my back office compliance burdens? How do I do more with fewer compliance officers? How do I get rid of some of my distribution and auditing and reconciliation administrative burdens that have plagued these private markets over the past decade or 5 decades, whenever they've been functioning for? So when we actually go through the structuring process of how we can actually assist them with these very real pain points that they deal with on a daily basis, and when we tell them that tokenization is actually the answer to that, that's kind of the aha moment for them. What we specialize at, though, is completely hiding away the wires and abstracting away the complexity of blockchain technology. So what Nomyx offers is it's a comprehensive lifecycle management platform for your digital assets without the learning curve of blockchain. So both the experience for the asset manager as well as for the end investor or user of the platform is very traditional brokerage account-esque. So if you've used Fidelity or E-Trade before, and if you used an Apple Wallet before, you basically already know how to interact with these digital assets today. So that's kind of where my vantage point is, and that's kind of what encourages these clients to come on board. A side effect of this is that we're able to go to some of our liquidity partners, some of these both layer 1 treasuries as well as DAOs and other lending protocols that actually have a mandate to invest in tokenized assets. So in addition to removing all of these pain points in terms of reconciliation, compliance, distributions, we're also able to assist them with increasing their AUM by actually targeting these LPs that have a mandate to invest in yield-bearing assets, which is a much easier case for these asset managers to make to their respective boards or to their executive leadership, where, hey, not only am I getting rid of these pain points, but I'm also expanding my AUM and potentially opening up our asset class to a whole new variety of investors. And that's kind of where Nomyx thrives.
Okay, awesome. Rick, Franklin Templeton has been in the space for quite some time. Compared to when you first got in, I think it was around 2018. Compare that to 2025. How are your clients responding to the tokenization side of things?
Yeah, I'll start with, we're in a unique spot. Sometimes you get to build really cool things and products for clients that the clients themselves don't necessarily know that they need them just yet. So being at Franklin Templeton, we were allowed to break things, tinker with things at a very early stage. As Eleanor mentioned, we started our journey in 2017, 2018, and we're very lucky to have such a passionate CEO in Jenny Johnson. Before Jenny was the CEO, she was running operations for Franklin, so she had the opportunity to see things at the ground floor and at a kind of vantage point where she saw the vision of the future in terms of what we were thinking about, what we were trying to achieve. We started out by thinking about what public security could we potentially put on chain? At the time, we decided to go with a U.S. government money market fund, and it wasn't about building a digital asset team. Rates were at 0, so no one cared, right? It was all about seeing if we could utilize public blockchains and revolutionize our own operations and explore cost efficiencies, and seeing if it was even possible to explore the tech, break the tech, stress the tech. So, long story short, we were the first asset manager, here at least in the U.S. to tokenize a public security, put it on chain. We're now live on 8 public blockchains. We created our own Franklin Templeton hosted wallet infrastructure. We created our own digital transfer agent, where the official shareholder records are the authentic source of truth on chain. We're not running shadow copies, duplicate records off chain. This is, the authentic shareholder records on chain. So for us, we built out the infrastructure, from the ground floor up, and we're really starting to see the galvanizing point right now where things are really heating up in terms of how not just crypto native clients, but traditional institutional clients are looking at tokenization and looking at ways to explore opportunities. You know, we also created our own tokenization engine itself that tokenized our US government money market fund. So we're talking to a lot of different folks, institutional players, about not only using our Benji token, but using our Benji platform to tokenize their own strategies. So there's a lot of exciting things that are occurring within our group. And we ultimately, you know, believe very strongly that our competitors become our collaborators. So we're always excited to talk with a lot of different players out there about how we can evolve together, because we're all in this together. At the end of the day, if the digital asset space grows from asset managers, you know, here and other players here, we're all going to win. So I think ultimately it's about building unique strategies and products that you could build for clients that they could use and find value in it. And I think that's what the beauty about using blockchain is in terms of large asset managers, stressing the tech, breaking the tech, and, you know, doing a lot of different things that you can, you know, use on a daily basis as well.
Great answer. Andrew, I'm going to carve it up a little bit with you. Tell me how your clients are thinking about tokenization and blockchain technology these days, and also what have been the biggest challenges for a big financial institution like Northern Trust to integrate digital assets into like a legacy financial system?
Yeah, so
Two-parter.
yeah, kind of two parts. So first of all, clients, right? And what are our clients thinking? So obviously a traditional institution, conservative, 135 years old, but with a concentration on institutions and wealth, I think it's kind of interesting because even the varied part of our client base are being exposed to this in very different ways. If you look at the wealth side, it's very much clients that are looking at the speculative asset part of cryptocurrency and how they've been able to, you know, move some of their wealth into that. And so we obviously really want to be able to serve them for those products, just like we do for traditional products. So that's part of what led us to where, you know, we started to grow too. But on the other side of it, when you think about sovereign wealth funds or not-for-profits, universities, et cetera, their exposure to it came and is coming from donations, distributions, things like that. And they started with, okay, great, I got this donation in Bitcoin, how do I turn it into $1? That's all they wanted to do. The evolution of it has become, do I want to turn it into $1? Do I want to hold it? Do I want to turn it into something else? It's a tradable asset, right? So a couple of different ways that our clients are starting to look at it makes us think about how do we really expose our clients to solutions that tie digital market assets to traditional asset markets as well. How do we integrate? How do we give them the capability to evaluate and transact and total and calculate anything else across a single portfolio where they don't have to log into a bunch of systems, right? Because the second part of this question, how do we, you know, kind of view that challenge part? I think there's, again, it's kind of a two-part answer. I think there's a challenge around, as we think about first world countries and big companies, we have a very established financial infrastructure. And look, I have been working on transformation in traditional finance for about 25 years. And I used to build electronic trading systems. And I'd always refer to that because I think, man, like in 2002, I remember building electronic trading at a major exchange in Chicago and going down to the trading floor and people telling me, well, you know, you're at 3% electronic. you're going to get to 5% soon. I was like, 5%? We're going to be at 3% floor trading soon. So but the challenge there and the challenge here is, how do you create that infrastructure that not only works with traditional and existing infrastructure, but helps to evolve it? So we all talk about interoperability, but it's even beyond that, right? Interoperability is a nice word that gives us this idea that everything works together, but nothing works together. I mean, for those of us who have been in this space for a while, what we really know is that most of the infrastructure was built 50 years ago, and everything else is just chewing gum and duct tape, right? So how do you use the new infrastructure and start to evolve towards that for more and more tasks, but keep the reliability and the resiliency that you've become very comfortable with? So that's one of the biggest challenges. I think the other big challenge is getting your regulators comfortable with both the technology changes and the product changes, and having them recognize that assets are assets. And if something is tokenized, especially if it's a fund, if it's a security, if it's an equity, if it's a bond, that's what it is. It's a product. You don't want people regulating the technology. The technology is just a solution. And you certainly don't want anybody writing legislation that says blockchain can only be this, because in 5 years, we may not have blockchain. We may have some much better thing, right? And I don't say that because I think there's a much better thing. I just say that because we all thought the internet was the end of that, right? So as we build to Web 2 and Web 3 and Web 4 eventually, right, we'll get there, and we'll figure out what that means. So I think those are the two big challenges for us. And I think our clients are becoming very, very interested, and I know we're going to talk about regulatory in a little while, but the sentiment around the regulatory being more positive for traditional companies is something that we feel brings a lot of our capability to bring safeguards to our clients.
So just to add to that, in terms of interoperability that you were mentioning earlier, like if you look at the problem isn't with blockchain and with tokenized assets and your smart contracts that are actually going to be orchestrating your entire issuance or distribution. The challenge is that legacy systems that were built, your ERP solution that was put in place 10, 15 years ago, isn't made to work with that blockchain infrastructure, so it ends up creating data silos within your organization. And that was kind of one of the primary focus that Nomyx's platform focused on, which was creating an ETL layer that sits kind of in the middleware layer that can sync or trigger actions in your ERP solution in terms of reporting when a certain distribution or a purchase happens on chain, or vice versa as well, right? So there should be a two-way sync between your legacy systems and your new tokenization framework, so that regardless of which screen or which platform you're looking at, there's no data silos and there's no discrepancy in that information.
Well, I would even say the other part of this, right, is thinking about things that have been built into the system because you had different types of products, right? The first thing that always comes up when somebody from technology says, well, what do we really have to change? I'm like, I'll make it easy for you. What product do you have that goes to 18 decimal places? Much less 34, right? I mean, the precision of that, you know, because I remember it used to be we could record transactions in tenths of a second, and then we got to milliseconds and microseconds and everything else. And every time there was a change to a parameter, or even worse, to a hard-coded, you know, solution. So just that little thing of the solutions that's created creates so much precision around that reporting, which is a great thing. Transparency, access, precision, right? And assurance around that reporting structure. But that little thing is just like right off the bat. That's the first thing I bring up, and everybody just goes, yeah, we do have to fix that. So,
right.
Yeah.
And one of the other challenges that we kind of foresaw in the market was, I'm one of those people that actually enjoys reading white papers, strangely enough. Like, that's light reading before bedtime. What we saw was everyone was kind of rushing to tokenize. They were creating new standards, new frameworks around tokenization, and mostly it was being done behind walled gardens because and this is something that Annalise touched on in the panel earlier, as well as JP Morgan touched on, there was no verifiable digital identity standard that can be reusable, that is composable, that actually allows you to enforce those traditional financial controls in a decentralized environment, which is why those walled gardens and those permission chains were very popular for POCs, because you can do asset freezes, clawbacks, liens, and you can onboard everyone in a very, the same way that we've been doing that for the last 20 years. So giving financial institutions those kinds of controls in a decentralized environment was absolutely critical, so you can actually begin to unify the liquidity that is currently fragmented across 20 different permission chains, right? That's why identity is such a massive part of our tokenization framework, where, yes, tokenization standards matter, but if they do not work with a composable, reusable identity, they're really not worth the contracts that they're written on.
Flexibility and reusability, that's how we build everything now.
I think we saw maybe a blueprint for how tokenization is going to play out in the real world. If we looked at Larry Fink, who's the CEO of BlackRock, his annual shareholder letter, which came out earlier this month, and he basically said something along the lines of, everything will be tokenized, every asset, every stock, every bond. My question to you, Rick, is do we need to tokenize everything, and what are the benefits of the things that we do tokenize?
Look, I think ultimately you'll live in a world where everything will probably be tokenized. The same way you view when the ETFs first came out about, 20 years ago, give or take. You could probably see this space evolve very similarly to that space, where the ETF revolutionized. It was a step above the mutual fund, and it changed the landscape of how investors got access in a very easy way. It's the same thing here with tokenization and using public blockchains, and how there's a lot of different parallels between, how that occurred versus what's happening now. Now we're just creating things that can be more efficient than the legacy systems. One of the reasons why we explored, public blockchains in the beginning is that if you look at Franklin Templeton and all these other asset managers, it's a system of ledgers, right? So to us, to use blockchain made perfect sense, right? And it became more of just exploring efficiencies. The efficiency gains that we witnessed firsthand when we launched our Benji token to friends and family in 2021 was massive compared to our legacy transfer agent, right? So do the math, 50,000 transactions using public blockchain, was 0.00001, right? So you can kind of see how cheap it was to run our token for the first year. That has since evolved dramatically. So we've enabled a lot of really cool efficiencies within our platform, peer-to-peer transfers. Self-custody is now, you're able to, use your own self-custody wallet outside of our, walled garden, right? So we just see a world where there's a lot of exciting ways and means to enhance the client experience. And I think, yes, look, we're a large asset manager. We have every asset class from A to Z and some exciting other, brands within Franklin Templeton that would love to tokenize. But let's take a step back and let's get this right first before we start thinking about tokenizing everything. You still need, massive developers and engineers and teams that can do the tokenization as well. So yes, long story short, I think we will see a world where this will all be tokenized, and not just financial products, but everything. And I think, look, at the end of the day, we're still living in a world where, digital music is still pretty, it's not too long ago where we just started using digital music in our everyday lives. So we still have a long ways to go where everyone has a wallet. I still think we need to take a step back and look at, wallet infrastructure, and most mom and pops potentially having wallets. So there's a lot to go before we tokenize everything, but we're on our way.
So actually, something that you mentioned earlier, which was you still need teams of engineers to actually put together the solution. You still need them to develop new standards and actually integrate everything together. I experienced that pain point personally within our org at Nomyx for the last 2 years or so, where it would take us 3 to 4 months to onboard the customer, take them through discovery, create that asset class template on the smart contract, and then integrate in a KYC provider, a wallet abstraction service, integrate a fiat on-ramp, off-ramp to provide that comprehensive user experience, right? And what we realized was onboarding 2 or 3 customers every couple of months or having a bloated engineering team was going to just kill our overheads. So we spent the last 9 months or a year really building out a solution which took a Salesforce-esque approach to it, where we can deploy about 80% of what you need, which includes your smart contracts. It includes all your third-party vendors, including your KYC provider, your fiat on-ramp off-ramp service, your wallet abstraction service, as well as integration into potential liquidity partners. That can all be deployed within 20 minutes, right? And then once that deployment is completed, yes, you still need to go in and configure it just like you would configure any other SaaS platform, where you're going in and setting roles and permissions, setting up your workflows that cater specifically to your particular use case. But our primary objective there at Nomyx was to really take it away from, there's only limited talent pool in blockchain integrations or blockchain specialists that bridge that gap between DeFi and TradFi, that understands compliance in the TradFi world and also understand how to bring innovation from DeFi over into TradFi. You can't just get someone who's published an NFT or a meme coin to come and build your financial institution infrastructure. So we took the vantage point that let's give them everything that they need and let them bring like a web developer or a traditional JavaScript or a React developer. That's a dime a dozen, and every org already has them, where you're simply doing customizations in terms of access control and maybe an IT coordinator that actually helps you manage that platform. But all of the integrations are completely abstracted away from you. Instead of you having to, if you were to go and buy a car and someone told you, you got to get engine from BMW, your transmission from Mercedes, your shell from Toyota, and then you got to find a team of mechanics to put it all together, you might not be that interested in getting a car. You want to get the key and drive away. And yeah, you can add some aftermarket parts to it later, and that's really what we've done at Nomyx.
They told me you're a talker. Yeah, all right. You yap more than I do. But it's a good thing. You make my job easier. No, seriously, thank you for your contribution, seriously. I want to shift a little bit to regulation and how it's no secret that the regulatory environment has obviously opened up. It's become a lot more friendly in the last 6 months or so. How have you seen that manifest in institutions and how they approach their digital asset strategy? I'll start with you, Andrew.
I'll start. I will say that, clearing some of the challenges away from traditional institutions to really innovate at scale has been the biggest change, right? When we think about the issuance of SAB 122, the rescinding of OCC interpretive letters, things like that, the idea that traditional institutions can provide the services that they provide today for these types of marketplaces can only bring more safeguarding and security around this. And institutions and institutional traders, buy side, should follow, quite honestly. They are looking for the comfort of what they do today in the market of tomorrow. And so that's really where I was telling somebody earlier today, we aren't talking about, and nor do I consider this, the fact that we're loosening regulations. We're just clarifying regulations. I just want clarification. I don't think that there's anybody that wants no regulation in this marketplace, because that only gets people in trouble, especially people who don't really understand then, well, can I do this or that? I want to know. What can I do and how can I do it? And I'll build my solutions to do that. And so to me, and I think to a lot of people, especially in the institutional space, it is, let us know, give us the guidelines, the guardrails, and we will build the best solutions around that.
We'll pause for a mobile break. So look, Franklin Templeton Digital Assets has evolved in many different regulatory regimes, and I think we'll continue to do so. We're lucky enough to, build out this tokenized Benji token. It's a 40 Act SEC registered digital asset security. So we evolved from doing that in the early days of 2018, 2019. We're also in a world where it wasn't too long ago, if you look at the regulatory landscape, that 2024, a Bitcoin ETF was launched in a very different SEC regulatory construct. And then as we peer into, the last couple months and, as we evolve into 2025, we're now in another new SEC regime. So I think there's a lot of things to be excited about in terms of what could potentially be on the landscape. But I think all in all, I think it doesn't matter who's in the SEC, meaning I think we will continue to evolve in ways of working with whatever type of SEC or regulatory construct is in there. I think they want to learn as much about this space as everyone else in this room does, right? And that's the beauty of where we are today. So I think the regulators have an open mindset, and they want to explore with all these great, explorers in this room as well. So I think we're exciting times ahead.
You said something to me earlier. One second. You said something to me earlier, and I liked it. You said, we built during the Gensler administration and the Biden administration. Just think what we can do in this new administration that's much more open. So I just thought that was a good hot take. Ubair, go ahead.
I'm sorry, but that's a testament to all of the asset managers that are building, or doesn't have to be an asset manager, anyone that's building, right? Volatility, right? Tariffs, right? We're going to continue to build and do a lot of exciting things, right?
Okay, got one real quick thing. I think the most important part, and I should have stressed this earlier, is we all have to work with the regulators, like you said. Like we can't be working outside of the regulators because they want to know what we're doing, not because they want to stop us from doing it. They want to know why we're doing it, and the more they understand, the more they'll support it. So sorry.
No, completely agree with these gentlemen here. Now, legislation will always trail innovation. Like, that's the age-old adage. But it's somewhat a little bit easier in the RWA space, because especially in the private markets or alternate assets that we're working with, there's already some guidance or some frameworks, because these assets have existed for a few decades already. So as long as you're compliant with the current standards and the current regulatory wrappers that typically are associated with these alternate assets, for example, if you're doing pre-IPO securities or pre-IPO shares, you need to make sure they're accredited. You need to file it under Reg A plus or Reg A or Reg D, Reg S, depending on which jurisdiction you're trying to approach. So as long as you're catering to the current frameworks that govern these assets already and are simply creating a digital synthetic of these assets, which still allow you to practice those same kind of controls on a distributed ledger layer, you should be okay with most of the regulators. Now, as more clarity emerges or any policies change, there will be a requirement to maybe tweak a few things or modify a couple of things. And that's why I think upgradable smart contracts are such an important part of tokenization infrastructure today. Because if you go back 5 years, if you look at Bitcoin, if you look at ETH, if you look at any of the cryptocurrencies that have been issued that were speculative assets, I don't know who you were. I don't know who the issuer were. The issuer were not a regulated entity. I wanted to look at the code, make sure it was immutable so I don't get rugged and someone doesn't pull the rug out from under me. Now, when you're a financial institution, that immutability becomes a liability, because you might have internal policy changes. You might have external regulatory mandated changes that you actually need to comply with. So having the capability to upgrade your smart contracts without disrupting the end user, so the end user experiences not going through token migrations, but rather, ooh, there's new terms and conditions available. Click, and I'll continue as I go. And that's why we built everything upon upgradable smart contracts whenever we're tokenizing anything, not just to keep us compliant with regulations today, but also future-proof our clients' investment into the future.
Just on that, you touched on how basically the privacy aspect of the blockchain, right? It's such a feature, or actually some will call it, the be-all, end-all of blockchain technology, right? Privacy and user autonomy. You at Nomyx are trying to bridge that gap between how institutions think about privacy. Obviously, big institutions are big into their privacy, and how do you bridge that with blockchain technology? I know at Nomyx you are doing an initiative that makes that maybe a little bit easier and kind of preserves both sides of that argument?
So it depends on the kind of privacy that they're looking for, right? The first layer of privacy that almost across the board everyone is in consensus with, whether they're a small asset manager or a large asset manager, is I do not want to provide personally identifiable information of my clients on a public ledger, ever. That's a big no-no. And that's against almost every single data privacy law, regardless of which jurisdiction you're operating in. The way that Nomyx ID works is we store all of the personally identifiable information with a trusted, regulated KYC provider that already services hundreds, if not thousands, of financial institutions around the world. They act as the top of our funnel for us. So they collect the data, they store that PII on their servers. I don't want to deal with that personally identifiable information, but I need an audit trail to go and validate that that information is there when my compliance officer needs it. So all we take and embed on chain is their wallet address, which we create for them, as well as their KYC account ID that we gain from our KYC provider. That's all encrypted and stored on chain. Now, when you actually issue a credential, for example, if I wanted to onboard Eleanor and you are a US accredited investor, we'll have you upload your W-2 or your $1 million in liquid brokerage account or a bank account.
I wish.
Soon, hopefully. But once we actually validate that, the only thing that goes on chain is you have credential 1, which only my compliance team knows that that credential 1 actually maps to an accredited investor. All your PII is stored off chain. And that's what our legal teams that have advised us to do. That's what the regulators that we've spoken to, they don't want that data on PII. Now, there's a next level where some very large financial institutions might say, I don't want to unveil my trading partners. I don't want to reveal my transactional volume, my ticket sizes. And for that, I think there's still a space for things like private ledgers, right? And now you've seen Hedera come out with their Hashware. You've seen Avalanche come up with their Avalanche private chains. So there's still that use case for that, which, yes, it will fragment liquidity, but some of these larger financial institutions that are still playing in a closed environment where they have very limited trade partners and only those trade partners should know what's actually happening on chain. So depending on these layers, we can make the appropriate recommendation to our clients.
Got it. We have 50 seconds left. I don't know where the time went, so I'm just going to do rapid fire. And I want to know, 3 to 5 years from now, where do you see digital asset infrastructure for institutions? And is there anything that needs to happen to accelerate that process, Andrew? As rapid as you can, I guess, with a question like that.
Now, look, in the next 3 to 5 years, I mean, the sarcastic part of me, which exists quite largely, wants to say, I just want a taxonomy, for God's sakes. I just want to know what everything means, right? Like, when I say crypto asset, does that mean the same thing as when you say crypto asset? But it looks like the CFTC is down that road. So I feel comfortable with that. I would like to see in the next 3 to 5 years, I would like to see institutions and institutional providers provide more real use cases for solutions. And Rick, you brought it up earlier, right? It's not just tokenizing something to tokenize it, it's the right use case. We were fortunate enough that we launched a carbon ecosystem that allows for the tokenization of carbon credits and tracking and the lifecycle management, the registry around it. And it's worked for us, and it's growing. And I think that just is a signal that we can do this in other marketplaces where there's inefficiency, and we can help put a surety and efficiency back into the marketplace.
Yeah, I'll just say, excuse me, 3 to 5 years, blockchain, tokenization, wallets. It's a thing that is a commonplace in everyday society where the same way you drive a car every day, you don't necessarily need to know how the car works, you just know it works. So the infrastructure works, and for traditional, like I said, Franklin Templeton's built its business with traditional clients, the Morgan Stanleys, the Merrill Lynches of the world. That world will start bleeding into our world where those traditional clients will start using these tokenized strategies, these BTC ETFs, and all the other exciting products that we're building. And it will not be a traditional versus digital world. Everything will be combined and will be in this whole new paradigm shift where all these exciting products will live freely in a wallet or an SMA or whatever it may be. It's all about choice, as I said before, right? Giving clients choice and how the clients want it.
So maybe not 3 to 5 years, but maybe 5 to 10 years. Something that I always like to think about is when Bill Gates went on the Letterman show back in the 90s, and this was when the internet was called the information superhighway. And he was like, every single home and every single business is going to be connected to the information superhighway. There was a massive cackle from the crowd, like, yeah, right, okay, whatever. I think tokenization and blockchain will do the same. kind of transformation to not just the financial industry, but almost any kind of record keeping, whether it's supply chain, logistics. Almost every industry will be touched by it without even knowing that they're being touched by it, right? You need to have that refined user experience where that friction points of storing your private keys, having to deal with wallets, that's all abstracted away from the user. And like Rick mentioned, it just works for them, right? And in order for this to be facilitated, what we need is, especially in the financial landscape where we're playing right now, would be a unified, composable, reusable identity that travels with the user across multiple chains. So maybe a consortium would be founded around identity standards. That consortium will come up with industry best practices, which will eventually translate into industry standards. And once those standards are established, that liquidity can move across multiple chains instead of being, no, this is only on Stellar or this is only on Avalanche. That's the first thing that needs to happen. And then secondly, your liquidity providers that are actually coming on chain, we need to find a way to unify those liquidity and allow them to move alongside those identities and alongside those assets between multiple chains, where if you go back 10, 20 years, you could get software for a Mac or software for a PC, and certain software didn't operate with the other. You need that level of interoperability, which will only come from unified standards and those industry best practices being created around them.
Awesome, guys. Thank you, Ubair, Rick, Andrew. You've been awesome. Thanks for listening, guys.